All right, Hunter. Well, a lot of times the summer's not the most exciting time to be in and around the markets, but boy, have we had quite the June, July, August, particularly the July period. We saw a ton of volatility, one of the biggest momentum unwinds and most rapid that we've seen in market history. And lo and behold, we're already back close to all-time highs. So it has been quite the swing. So I want to talk about the market swings of summer, or the stock swings of summer today. What exactly happened in July, kind of where that leaves us. We're going to talk about fundamental versus technical. I want to define those terms, give our audience some information, some insight into our thought, our decision-making process when it came to these market moves, what we're thinking, and where we sit today. So why don't we just, go ahead and kick that off?
Yeah, absolutely. We had a fantastic year to date up through the first half of the year, just kind of as a little bit of a background, because when June highs, turned into July local lows. I mean, we're still well above where we started the year for, context here, but the S&P drew down almost 12% in that time frame. The semiconductor index was down 29%. And the Korean stock exchange, their whole version of the S&P, their whole stock exchange was down about 40% in just about a month. You hit it pretty much the entire month of July was a red month. And in some areas more than others, like you mentioned, momentum, it was pretty painful.
Yeah. And I think this podcast is important because we almost had to wait to get this podcast out because we had so many client conversations during that time about, hey, what's going on? Why is the market doing this? These companies seem valuable, but the price just keeps decreasing, day after day, week after week. When will the pain stop? And I think that's where you have to get back to your investment thesis. Focus on why are you investing in these companies in the first place, because really defining why we had that July downturn, it comes down to that fundamental versus technical analysis part of the equation. So, kind of before getting into the heart of those issues, I want to define the difference between technical versus fundamental. You and I are fundamental investors, meaning we focused on company operations. What is the company doing well? What does their balance sheet and other financial statements look like? How are they incorporated into their sector or industry within the market? How do they relate to the broader market? What's going on macroeconomically that impacts that business? All business and economy centric being those fundamental factors. Now, when you get to technical, it's more focused on the trading. It's about the stock price. It's about the dynamics of the stock market. Not so much what's going on with that company specifically, but what does the demand for shares look like? Where are people borrowing money to invest more in certain types of stock or certain investments? How big of a position has an individual company grown to in a portfolio and an index and any of those things. So it's more about the stock market factors, what's driving that price action, rather than anything that really has to do with the company. So if you're thinking about fundamental factors, think about company specific and economic specific. If you're thinking technical, it's more stock market and share price. So I think that's at least a relatively simplistic way to think about it, unless you thought I was missing anything there.
No, that's a great way to explain it. I like to think of technical being kind of how individual investors are interacting with the stock, because regardless, and kind of what we saw is regardless of fundamentals, people always have their own motivations. Some people just need cash to pay their tax bill, and you'll see sometimes you'll even be able to see those effects in the marketplace in April and October. You'll sometimes get a little dip around tax season and certain things like that aren't necessarily fundamental things, but it's just individuals with their own motivations that are prompting them to buy or sell stock.
Exactly.
And so kind of, translating that into what we saw is that people got really heavily invested and kind of localized into the memory and semiconductor space, which is why we quoted the SOX index earlier, which is an ETF of mainly the semiconductor stocks, and then also South Korea, because the Korean exchange, half of it is dominated by two companies, SK Hynix and Samsung, which are both very much in that space. And so when people get really overly concentrated, they're chasing gains because these stocks had done so well, but that leaves them exposed to market pullbacks, and that creates a lot of issues in the system.
Right. It's what we like to call in the industry is a lot of froth. Heavy positioning in a small industry or sector. And the thing was, people were in these stocks for good reasons. I mean, these companies have just been absolutely crushing earnings or earnings growth or revenue figures. They're in super high demand as part of this data center infrastructure. So it's not that the fundamental factors were lacking. If you're looking at it from a fundamental perspective, these companies were well positioned. They deserve the gains that they saw end of last year, so far this year. But those positions, along with the increase in share price, became larger portions of portfolios as well. So not only were a lot of retail investors, individuals chasing these names because they saw, oh my gosh, these chip stocks are up 50%, 100%, 200% year to date. I want a piece of that action, so I need to go ahead and buy in so I don't miss all of it, which also happens on the institutional side. A lot of professional investors, if they miss a trend, they might try to hop on late, and we'll get to some of that in a second. But so it's a combination of people chasing those names, as you mentioned, and also having too much weight in them in their portfolio because they've grown so much. What started as a 1% position may have grown to a 3, 4, 5% position depending on the company. And so all of a sudden you're getting to this July 1st date, and what happens on that quarterly, or in this case, quarterly and semi-annual date, is people rebalance their portfolios. A lot of institutions decide, hey, quarterly, we're going to rebalance, meaning anything that grew too much or is out of weight, we're going to bring that back in to a normal weight that goes along with all the other positions in the portfolio. Some things that underperformed, maybe bring those up. Well, that creates some forced selling. Again, a technical factor, not fundamental. And so that kind of catalyzed some of this decline in stock price. And it just kind of created a snowballing effect. And I think a big contributor to all of that was also leverage. And Hunter, I want to kind of have you cover what is leverage, what's margin, how did that impact all of this?
Yeah, and so leverage can be taken a few different ways. On the very retail side, it's just borrowing against your stock positions to, you're borrowing cash against those to further invest in those same names. So all of a sudden you have more money invested than you actually have necessarily. And that happens on the retail side. Again, ton of that happened in South Korea. But also on the institutional side, there's a sad but interesting story about a hedge fund that was super levered to the trade, where they actually sold short. So they shorted software names and used that money to fund leverage into these semiconductor and memory names. And so they kind of have that two-sided trade there. Well, the trade flipped backwards. Software started doing really well. The other semiconductors started doing poorly, so they got hit twice as hard. And that's kind of gives you an idea of where leverage can get you, is that all of a sudden you have so many dollars and such a large percentage of your portfolio tied to one thing, that in this case, all that technical forced selling caused that relationship to flip and really wiped out a lot of people.
Yeah, I think the best way to kind of look at leverage is as an amplifier. It's going to increase your upside if things are going the right direction. It's also going to amplify your downside if things are going against you. And in the case of this hedge fund, situational awareness, they had the wrong bets on each side. Now, they weren't wrong from a fundamental standpoint. What they were invested in made them huge gains up until that July period. They were up something like 400%.
Absolutely.
For the year, but the entire fund essentially had to get unwound to pay for that margin and leverage debt that they had accumulated. And that's just, that's a lesson in one, risk management if you're a hedge fund and you're balancing these things, two, being cognizant about position sizing and things like that. But all of that really goes to show that this wasn't a fundamental thing. It was that leverage, and then these individual investors getting margin called. So if, as you mentioned, you're using that stock that you have as collateral for this loan to buy more stock, essentially. Well, if the stock decreases in value, all of a sudden your collateral is not worth as much. The bank or the financial institution lending you the money to buy more stock wants to make sure that you can pay them back. Well, they can do this via the computer. They can do this automatically, technically. They can say, hey, I see how much your stock is worth. I want to make sure I'm going to get paid back. So you're going to have to convert some of that to cash, which means they're going to have to sell some of their shares in order to pay for that margin debt. Well, what happens when you sell? Prices go down, and this just cascades on itself. I mean, this was no more apparent than in South Korea, where 3.4% of the entire adult population got margin called on their portfolio, which is an insane statistic. I mean, that's essentially you're wiping out portfolios of 3.4% of that country. And so it just kind of goes to show how dramatic that downturn was, how rapid. Had anything really changed with the fundamentals of these companies, the way that they operate? It hadn't. But the technical factors really went in the wrong direction, which caused this kind of cascading effect and took a lot of selling to kind of settle the market there.
And I think what goes to show that nothing had really fundamentally changed and that this was a technical factor is not just the reported short or margin balances or any of that, but also the fact that in July and really early August, once companies started issuing quarterly reports and earnings reports, you saw that the earnings trajectory continued. These companies are still making a ton of money. Hyperscalers, your Microsofts, Amazons, Googles of the world, still spending billions of dollars on those companies' products. And so the fundamentals never changed through this whole thing. And that's really what helped right the ship, as it were, is once companies started reporting, hey, we're still making a bunch of money and we have line of sight into a whole bunch more money after that, really went a long way to settle investors and help the market kind of back on the upswing and recover like it has.
Yeah, I completely agree. And I think before getting to where we are today, what we saw through that Q2 earnings season, one more note that I want to make is just a note on market structure. Another technical factor about the environment that we're in with stocks today is that leverage and margin have become much more easily attainable. More people are trading options. More people have access to these levered vehicles, particularly the levered ETFs. I'm sure if you're a retail trader and you do some of your own investing, you may have seen these 2 or 3 times ETFs, especially those on single names. So they had some of these on single stocks, 2 times leverage, 3 times leverage, which means on any given day, it's 2 or 3 times the return on that stock, either to the upside, but also to the downside. And we saw that a lot of the Korean traders love these. A lot of US retail traders were in these heavily. And that's just amplifying these swings. These products did not exist, years ago. And so you didn't have these rapid leverage-driven cascading effects that, can dominate trading for a month. Now, I think the important part is that, like we were saying, we had a lot of client conversations during this time talking about why there's value in these companies, why it's not worth panic selling at the bottom. And now we've ridden that through what you were just mentioning, a Q2 earnings season that showed that these companies are still driving excellent revenue, excellent earnings. The hyperscalers are still spending to a very large degree. They still have a very large appetite for spending. And those major companies are seeing an ROI on the AI investment that they're implementing, which pretty much gave a green flag to the market saying, hey, these companies are sound, the fundamentals look good. And it signaled to investors that, hey, maybe I'm not going to go ahead and take on a bunch of leverage to buy these names again, but all of a sudden I feel comfortable buying back in. And that's what we've seen, almost back to where we were at all-time highs. The S&P has notched a few all-time highs already, and NASDAQ is kind of following on behind that. But really interesting to see hey, let's focus on the fundamentals. That's going to drive that long-term price action, even when technicals can dominate for kind of a month-long period like we saw.
Absolutely. And I want to take a moment to highlight something you said there, that in earnings season, we saw the companies start announcing, companies being the hyperscalers that we talked about before, announcing that they're seeing positive return on investment of all of this AI money that they're spending. And that's a huge turning point for the industry, because leading up until this, everyone knew that there'd be a period of investment before you start seeing a return. That's how it works in business. But investors can get fairly antsy when companies are spending such huge amounts of money on this. You have companies who are traditionally very cash flow positive, very healthy on their economics, start raising cash because they realize this is such a accretive investment opportunity. Well, people start getting antsy when you're pouring money into something and not seeing that return quite yet. And I think a lot of times investors get a little more short-sighted than some of these big companies can get. That aside, them seeing a return on investment is a huge shift to justifying all of these hundreds of billions of dollars that have been invested into the AI space so far.
Yeah, you're exactly right. I mean, we saw Google with massive AI cloud growth, Microsoft with massive AI cloud growth, and a lot of these other companies really executing well on their AI initiatives. So that was huge. Now, this kind of brings us back, now that we've kind of covered all of that, and we welcome your questions in the comments or via email if you have anything specific on the whole theme of July, what happened, how we're recovering. But it kind of brings us to where we stand now. We've recovered a price level to a very large extent. And so that begs the question is, from a valuation perspective and more from a fundamental perspective, how do we feel about these companies? Well, we kind of answered that with the Q2 earnings talk. But if we're looking at the valuation metrics, meaning, how much am I paying for each dollar of earnings, what we typically refer to as a PE or price to earnings ratio, is used as a valuation metric to kind of determine if investors are overpaying or underpaying for investments. Well, I thought a big one that hadn't really hit me until I was kind of reviewing the data was that the S&P is actually cheaper now, even after we've run up into the kind of low teens percentage for the year. It's actually trading cheaper than it was because of how strong the earnings growth has been so far this year. It's actually trading cheaper than it was at the beginning of the year. At the beginning of the year, we were trading somewhere around a 23 times price to earnings multiple. Well, now we're closer to a 21 times. So that just kind of goes to show, hey, you're actually getting more value for your money despite the increase in stock prices now than you were at the beginning of the year.
Yeah, I think that's something that a lot of people, don't really give enough credence to. We've talked about this on numerous occasions with NVIDIA over the past few years, while it was moving, huge amounts of percent in price, but its earnings were outpacing even the price increases. So right. You'd hear people say, oh, NVIDIA is really expensive. Well, on a price to earnings ratio, it got cheaper. And now we're seeing that for the whole market. And so I think that's a pretty, incredible thing, but also super important to keep in mind, because I think a lot of investors get these kind of price levels for the S&P or for the Dow, stuck in their head, and 7,800 sounds like a big number for the S&P. It's not about the headline number. It's about what that represents, those earnings that you're buying with that. And now you're getting more earnings per dollar than you were before.
Right. Even the tech sector, the area that's had the most focus with all this AI craze, even it's trading cheaper compared to where it was at the beginning of the year. So a lot of these companies, despite increasing, maybe 100% or more year to date, they're actually still cheaper on a valuation basis than they were at the beginning of the year. Of course, this is reliant on continued spending in the AI space, continued return on investment for those companies that are doing the data center spending. But so far, the picture looks good. It's something that we're tracking. Now, this is certainly not to say, go wholesale back in, buy those leveraged ETFs. We would suggest that investors, take a long-term approach. Don't buy the levered ETFs. focus on fundamental investing. I mean, that's what we do at Beck Capital. It's been, I believe that we've been prudent stewards of capital, that we've done well through this investing cycle, and also try not to panic whenever you have these unwinds. So if you have an advisor, talk to them beforehand, but sometimes it's best to keep her cool even when it feels like everything's falling apart.
Absolutely, Victor. I think patience is kind of the takeaway there, is be patient on the way up. By not over levering or overextending yourself, but also be patient on the way down, because usually there are corrections in the markets when things are going up. But as long as the fundamentals aren't changing, the long-term picture is still what's worth focusing on.
Absolutely. Well, Hunter, thanks for the time today. I enjoyed the conversation.
Yeah, thanks, Victor.